Vishal here has asked us that how does macroeconomics helps in trading in stock market. Vishal, what I would like to say here is today in the trading world, whether you are trading either commodities or equities or currencies, what happens is that all the markets are so interlinked with each other. Like the domestic markets in India are interlinked very sharply with the global markets, be it Japan or China or Europe or USA. So, like you would have seen in a very recent example last week, that China increased the peg, so they devalued their currency, and we had a big shocker wherein our own currency depreciated by around about 2%. So that is a practical example wherein you have seen how any global change, whether it is economical or political, affects our markets so sharply. So this is because the markets are interlinked with each other very well. Today, most of the trading takes place by the foreigners. So what happens is that because so much FII money is coming in, what happens is that it becomes very necessary to understand how the global economy is doing if you want to be trading in the market. So what happens is that if I am trading, even if I'm trading currencies or commodities or equity in the Indian market, it is very important for me to understand that how the Asian markets are behaving, whether it is China or Japan, how the European markets are behaving, and how the US markets are behaving. Now, to understand that, it becomes very important to understand the economics of all these countries. Because economics is only the way by which you can try to decipher all these changes which take place. Just a moment. Yes, so where I was coming back to it. So what it becomes important, very important to understand how the economics in each of these countries are behaving. Like if I take for a recent example, what happened in China, that they devalued their currency by 2%. Okay, so that was a weakening of the Chinese yuan against the dollar, but it affected all other currencies as well. So we have seen that any single change, whether it happens in any country out there, be it the bigger economies like China, UK, Europe, US, Australia, Japan. So any changes out there happening affects our market very sharply, be it any asset class, be it interest rates or equities or commodities or currencies. So it becomes very important for us to understand how the economical viewpoint is changing in these countries, what is the economic policy currently, and how are these going to shape in the future, because markets predict the future. We play 1 year at least down the line forward markets. Like another example would be that US is expected to increase interest rates by September or December this year, but this has been playing out in the market since the last year. You would have seen the American markets, they have not gone anywhere for the last around about 12 months or more. So they have been trading in a range. That is because people aren't decided as to what will happen with respect to the interest rates. Okay, how would the US government change it? Okay, so when would that happen? When will the Fed increase interest rates? The changing macroeconomics affect both on the short term and long term as well. It is difficult to understand. It is very difficult to understand the short term changes. Markets can behave wildly. So you might have short term changes which are not in sync with the economics, but the long term effects mostly remain the same. Like for an example, it would be like US is expected to increase interest rates. Okay, so interest rates in a country are increased only when either the country is doing very well on the GDP front, or you are seeing inflation happening. So this is the long term reason why you go and increase interest rates. Why would I increase the cost of borrowing. I would increase the cost of borrowing only when I see my country doing very well on the GDP front and also on the other macro data points. Secondly, I would have a risk of inflation, like the asset prices might be inflating too much. So what I'm trying to do is that I'm trying to slow it down a little bit. So that is one long-term effect of increasing interest rate. And in the short term, what can happen is that you can have a varied movements. So it is difficult to predict that what the short-term movement might be. But in the long term, if you have a very good understanding of how interest rates affects the market, it becomes easy for you to play either on the long side or short side and on with other asset classes as well. Okay, so we have another question. See, what happens is that NSE is an exchange. So I think you would be asking about Nifty. See, what happens is that prediction is impossible, as you have yourself said. What we try to do is that we try to make a calculated or educated guess of the future. Okay, we don't try to guess the market, like where is it going to go, or make predictions that the market might go up or might go down. What we try to do is that whatever factors are being presented to us or whatever facts we expect the market to go through, we try to make calculated guesses on that front and try to see that where the market might be in the near future. Okay, like for an example, last year, if I go to the past, in May, you got a very strong government coming in. So what happened was that the markets shooted up very fast. That was, if you would have made an assumption of this in January itself, that if a strong government comes in, what might happen is that the policy logjams might go off. So we might see very strong market moves. So anyone who would have made a calculated guess in March or January or February, like if X happens, like if a strong government comes in, we might see the markets going up very rapidly. So they might have played it out accordingly. Secondly, now coming to the present, what is expected to happen, that interest rates in India are expected to decline further. Might not be in the near future, but over the next 2 or 3 years. So interest rates are expected to go down because inflation is coming off. So what a person like here can do is that he or she can make a calculated guess that if interest rates comes down, what happens? The cost of borrowing goes down, the demand for houses go up, the demand for personal goods go up. So we can make a calculated guess based on this. Like for the next 2 or 3 years or for the next 6 months or 8 months, what sector is expected to do very well or which stocks are expected to do very well. So this is how a fundamental knowledge can help me out. If I know that interest rates coming off is good for the banking sector, then I can do what is that I can be long on the banks for the next 6, 8 months or 12 months till the time that I am expecting the interest rates to come down further. Okay, and markets play the future, they discount the future a lot. So what is expected to happen is that if something is expected to happen by the next year, you might see it playing out right now also. How would you take advantage of that? That if you have a knowledge of how interest rates would affect or how crude prices might affect, like we see crude prices going down very sharply right now. So all the companies which use crude as their raw materials, you are seeing a very good increase in the share price of these stocks. For example, a Berger Paints or an Asian Paints or some plastic companies. So if a person has a knowledge that crude price going down is good for some companies, or which companies is it good for, then they can play this bet accordingly. Like we can be long on stocks which are expected to do very well once crude prices go down. So this is how a fundamental knowledge of something helps you out in taking an influence from global market. Now crude is something which trades in the global market. So if you are seeing crude go down very sharply, and if it is helpful in the next 6 months or 8 months for these stocks, then we can take a long or short call on which stocks we want to. Based on this premise, like if crude is expected to go down, I would be long in Hindustan Petroleum or an Asian Paints for the next 6 months or 3 months till the time we are seeing a similar trend playing out in the global markets. Yeah, okay. So was that clear to Saurav and to Rahul? Okay, sure, okay. Yeah, so we have a question by Parth about what is meant by DuPont analysis. Yeah, so is the sound clear right now? Yeah, okay. So I'll just get started with it. See, DuPont analysis is what is like we calculate the ROE. ROE is the return on equity. I suppose you would know that. So return on equity tells us that how much a company earns on the basis of its net worth. So what is the return based on the net worth that the company employs? Okay, a higher ROE is expected to be something which is good for people. So good for companies. So we look for companies which have a very high return on equity. Why? Because the company is able to earn a higher return on the equity that it employs in the business. So basically what you are getting is that you are getting a higher return on the equity employed in the business, means higher return for equity shareholders. These are examples of efficient companies. Okay. So what we try to see is that if companies are efficient, okay, so the higher the ROE, the more efficient the company is. But we have a catch with this also. Okay. The ROE of a company can be boosted by other measures as well. So what we try to do is like we try to I'll just show